joining me is investment expert Roger the Dodger Montgomery. How are you, mate?
I haven't been called that since primary school. What's interesting to me is that sometimes people just get it and they understand the way I invest, and you either get it or you don't, and it's not my job to convince people. All I do is just talk about what I think looks like good value and the way it works, and that's what I thought we might talk about tonight.
Yep.
Talk about some of the companies, and I've just got to find the file that I want, but talk about some of the companies and look at them the way I look at them, so that people understand immediately whether it's a good business, because there's a very real difference between trading stocks and buying businesses.
Yeah.
And I think a lot of what passes for investment advice on television, on the radio and in the newspapers is really, to me, akin to gambling. So it's all about, well, if you buy this one, it could go up.
Yeah. And they're sort of saying, this company looks good at the moment. The price has gone down. We think it's $28. We think it's going to go to $32.
And they talk about target prices. Well, it's a little bit like saying, well, I think it's going to land on black. I think it's going to land on red.
Yeah, but there's a little bit more analysis
Is there?
Well, let's debate it. Let's just use Wesfarmers, because you always pick on Wesfarmers.
Sure. And
one of our experts this week said they like Wesfarmers.
Sure.
It's 28. It's been around the 30s. They're probably thinking it could easily get back to 32. There's $4 profit on a $28 outlay. 1/7, not a bad return. What's wrong with doing that? It's not just throwing it's going to go on black.
Because the price, the current price.
I'm playing devil's advocate here.
No, and which you're gaining a reputation for when we're together. Yeah. So the problem I've got is $28. If I pay $28, am I getting a price? Am I paying a price that is lower than the value I'm receiving? Because investing is all about just paying less for something than what you get in value.
That's the best way. You said investing is always the best way of investing would be that. But look, some people do invest the other way and still make money because the market helps them, doesn't it?
If you don't know what something is worth, and this is back to the question about Wesfarmers, if you don't know what it's worth, then you pay $28, you cross your fingers, close your eyes, and you hope that tomorrow when you open your eyes it's $32 and you make some money.
But there's a little bit more than the eyes being closed, the fingers crossed. Some people will say if the market goes up, say 20% over the next year or two, Wesfarmers, well, even if it does 10% on that, over a year, 10% is not a bad return. It's a good brand name. And all
can I just cut across here?
Most definitely.
So you said if the market goes up 10%.
20%.
20%.
And
if the market goes up.
Might do 10%.
Okay, and how do you know if it's going to do that?
Oh, there's speculation that because it's a top 20 stock, and the top 20 stocks often get those sort of returns, 10 or 12%.
But it does require the market. It does require the market to go up.
Oh, yes.
And I don't know about you, but I have no skill in forecasting what the market's going to do and where prices are going to go.
No.
So that's why I
have more skill than you in that area,
well, maybe.
I must admit.
Well, that could be true.
But it's still a tough call, and it's risky. It's a bit of a game.
Well, that's why I say to you, I think the smartest thing to do is to buy businesses below what they're worth. Then you're not betting on the price going up. You're simply waiting for the price to recognise the value. And it happens time and time again. I've talked about it before here on the program. You know, the intrinsic value of Qantas 10 years ago was about $3.80 or thereabouts. It's now closer to sort of $2. The share price has done exactly that. The intrinsic value of Telstra 10 years ago was about $4.12, and the share price was closer to $9. Now the intrinsic value, and I've said this many, many times on the program, is around $3. So when it traded below $3, well, suddenly you're getting a price that represented good value because you were getting more than what you were paying for, and it was the first time in 10 years. But it took 10 years for the share price to eventually catch up to that value. Let's look at it. Let's think about businesses rather than stocks. Don't think of stocks. Don't bet on stocks. Buy businesses, and don't think about prices. Think about values. Okay, so on the first point, let's take Qantas. 10 years ago, and we could say the same thing for Telstra, we could say the same thing for Amcor, we could talk a bunch of companies in this regard. So 10 years ago, the company was earning $500 million profit or thereabouts. This year it's forecast to earn about $130 million profit. Now, if you and I were getting together and I said to you, here's an information memorandum and I'm going to start a business and we're going to make $500 million profit this year, but in 10 years' time it'll only be 130, you'd say, Rog, not interested.
Yeah.
And what if I told you, well, to get this business started, we're going to put in, call it $2 billion of our own money, and we're going to borrow $2.5 billion from the bank or thereabouts to get it going, and we're going to earn $500 million in the first year.
Yep.
Fast forward 10 years, we're now making only $136 million profit, but we've got about $5 billion of equity and almost $6 billion of debt.
It's not
so
a
we've got
story you're telling here,
double
Roger.
the equity, double the debt, and we're earning less than half the profit.
Yeah. Not a great story.
But Amcor's very similar. You know, if you look at AGL since 2006, you know, it's gone nowhere really for 4 years or thereabouts. It's generating returns on equity that are less than what you can get in a bank account now. So there are a lot of businesses like this. So the first thing I do when I'm looking at buying a stock on the share market is I turn the stock market off and I think about the business. And I ask myself, is this a business that I would want to own? Because what I do know is that over long periods of time, the price is going to follow the value, and the value tracks the performance.
Okay, so start naming. So we've got 5 minutes to go.
Okay.
People
So
got their pen and pad ready to write it down.
Well, right now there's a few businesses that I think are very good businesses. Now, I should say this. I'm not going to go through all of them. I put 15 A1 businesses, what I call my A1 businesses, on my blog. So there's 15 A1 businesses sitting there on the blog, so you can go and have a look at those. They're the businesses that I think have terribly predictable performance. You know, they've got great performance, high quality performance. They're also A-class because I think they've got virtually no chance of going under. So they're very, very secure businesses. So a couple that I think are worth mentioning right now because I think they're also cheaper than their intrinsic value. And we've talked about Oriton. Oriton is a retail business in a tough space, but they've got a guru running that, a real guru running, not me, but a real guru running that business. Sally McDonald is doing a phenomenal job. JB Hi-Fi. I think JB Hi-Fi is another business that is a category killer. There's no reason why that's changed in the last 6 months. People think it's gone up too much. That is not a reason to think that the business has deteriorated just because the share price has gone up a lot.
What's the intrinsic value compared to the share price right now?
Okay, so the intrinsic value right now is about the share price for JB Hi-Fi.
Good.
So it's around $19. But if it performs as expected, if its results come through as being anticipated, then its intrinsic value rises to about $23 or $24 for 2011 and $26 to $28 for 2012.
Next one.
Okay, so Oriton, another little one, and two businesses here. You have to be confident that the China story is going to continue. Two businesses in engineering, if you like, or mining services, Forge Group and Decmal. Two businesses, again, A1 style businesses, high rates of return on equity, no debt to speak of, great cash flow. And if you have a look closely, you'll find Decmal probably has a better quality of client than Forge, but both of them tick all the boxes. Recently, Clough bought a cornerstone stake in Forge, and I personally feel that they got a very good deal and the board should have done a better job of extracting more value out of Clough for that, but they did that, and that's by the by. That, unfortunately, now they have about 31% of the stock. Unfortunately, that removes one possible catalyst, and that is that someone else comes along and says to Forge, thank you very much, we'll buy you, because there's that big cornerstone stake there that's blocking them. So that removes that, but that's not why I invest anyway. So look, there's 4 businesses that I think are good businesses. There's another
Reject
11.
Shop. You always go Reject Shop. Has that changed anything?
The Reject Shop is a terrific business. Look, I think its value is going to continue rising, but it's not at a substantial discount to its intrinsic value right now. It's not an A1, it's an A2. It was an A1, they've borrowed a little bit of money now, so it gets an A2 rating.
Is there like a blue chip company in your A1s? None of those companies you've mentioned so far would be blue chip. One blue chipper, that's an A1.
Not at the moment.
Really?
Not at the moment.
Is that because...
But what do you call a blue chip? I mean, I hear that. People say that all the time. What is a blue chip?
Well, I think it's a company that's got a very good reputation, a great brand name. It's stood the test of time. It pays good dividends. It's a reliable company. It tends to go up with the market. There are plenty of good reasons.
Plenty of A2s. Not so many A1s. There's plenty of C5s that are regarded as blue chip.
Okay, well, next time we come, we're talking C5s.
All right, let's do that.